Hey, welcome to Tech Factuala, where you can stay up to date with the latest progress of technologies and gadgets. Tesla is an American electric vehicle and clean energy company based in Palo Alto, California. Tesla's current products include electric cars, battery energy storage from home to grid scale, solar panels, and solar roof tiles, as well as other related products and services. Tesla stock is very famous with respect to its revenue from the past years, but one investment researcher is sounding the danger alarm on the stock. New Construct CEO David Traynor calls Tesla the most dangerous stock on Wall Street. The main catalyst for the move higher is a recently announced stock split planned for August 31st, 2020. Stock splits, of course, create no actual value for a company whatsoever. But when it comes to Tesla stock, reality hasn't mattered for a long time. What actually matters is the story Tesla tells its investors and the stories they tell each other. Wall Street analysts are finally having to tear themselves away from facts and numbers and admit that Tesla stock is valued instead of hopes and dreams, which everyone believes it has the most dangerous stock in the market. If you want to get updated about top technologies, don't forget to subscribe to Tech Factuala for more riveting content. Just one click on the bell icon to be updated of when we post our newest videos. Let's begin with the top 10 dangers for Tesla stocks. Number 1. Tesla turns a profit, selling regulatory credits, not vehicles. Tesla's recently reported profits are based on sales of free regulatory credits to gasoline automakers, whose fleets, on average, don't meet regulatory required emissions levels. Tesla enjoys a 100% profit margin on these credits since the company gets them as a free byproduct of being an all-electric vehicle maker. In 2020 alone, Tesla sold $428 million in regulatory credits on its way to reporting GAAP net income of $104 million. When it removes these credits, Tesla's GAAP net income would be negative in each of the past 3 quarters. Selling credits isn't a viable long-term strategy. As other firms ramp up production of EVs and earn more credits, they purchase less from Tesla. For example, Fiat Chrysler CEO Matt Manley noted in the firm's 1Q19 earnings call that it expects to be compliant without the help of credits from Tesla by 2022. Without the profits from selling free regulatory credits, Tesla stock will have trouble increasing its already overstated profits. Number 2. High Tesla short interest added fuel to the fire. Tesla has always been one of the most shorted stocks on Wall Street. Short sellers have piled onto Tesla in the first half of the year, with the stock having lost close to 40% of the value since the start of 2019. Shorts were betting on that trend to continue. Over 37 million Tesla shares were sold short as of October 15th. It has since fallen to under 28.7 million as the shorts were squeezed. This means Tesla's short sellers have been forced to buy close to 9 million shares to cut their losses. This additional demand for shares added fuel to the stock's rally. Number 3. The Cybertruck attracted a stunning number of pre-orders. Tesla launched the Cybertruck late in November, and the event was a disaster. Initially, the Cybertruck was not well received, and there were questions about its design. Forbes even called it ugly as sin. However, Tesla fanatics quickly warmed up to the vehicles, as pre-orders crossed the 250,000 mark just days after the launch. Although the pre-orders don't count for much, Tesla is only taking refundable $100 deposits. It made a nice headline. And in a world where high-frequency trading, or HFT firms, are extremely prevalent, a good headline can often send a stock or even the entire market soaring. Number 4. Tesla cars will remain too expensive. Even with generous government incentives, such as tax breaks for alternative technology, potential customers of Tesla's models are still faced with a large price tag that starts at $75,000. Even Tesla's new lower-cost option, Model 3, is $35,000 before tax incentives and gas savings. The cars are not only expensive for consumers to purchase, but they're also costly for Tesla to make. Vertical Group analyst Gordon Johnson estimated that the company loses roughly $14,000 on each of the Model 3 vehicles it sells. This is badly affecting the stock of Tesla. Number 5. Credit investors have hopped on the bandwagon as equity cushion grows. At various points in time, as recently as June 2019, Tesla bonds have traded below 85 cents on the dollar, which would generally indicate a company in financial duress. More recently, however, the bonds traded this low despite a stock that was still around $185 and a market capitalization still over $40 BN, suggesting an extreme disconnect in views between credit and equity investors. This affects its stock incredibly. Your interest is important to us, so make sure that you're subscribed to our channel and ring that bell icon to get notified of our latest videos. Enjoy the rest. Number 6. Tesla stock broke out of a consolidation pattern. Tesla's downtrend came to an end when it hit multi-year lows near the $180 price level in June. The price level has acted as a strong support for the stock in the past. The stock then consolidated over the next 6 months, forming a symmetrical triangle pattern. It finally broke out of the pattern in October, and it hasn't looked back since. In technical analysis, the longer a stock takes to form a consolidation pattern, the stronger the breakout eventually is. Tesla should respect this rule. Number 7. Tesla may never recoup massive capex. Musk once famously noted about his company, "We are going to spend staggering amounts of money on capex. Lots of investors like to see high capital expenditures, but there has to be a payoff at the other end." This seems particularly true in an infant industry paved with failed startups. Development for the Model 3 and Model X cars has already received billions in capex. The battery factory comes with its own hefty price tag. Tesla spends about 1/4 as much on capex as General Motors Company, despite the fact that GM generates much more revenue. Number 8. Markets can remain irrational, but these events could send shares lower. While Tesla reported 4 consecutive quarters of GAAP profits, it's clear from our analysis that these profits aren't sustainable. The regulatory credits not only mislead investors about Tesla's profitability, but they also teach investors to focus on GAAP profits, which could set the firm up to miss expectations in the coming quarters. Unlike many other firms, consensus expectations for Tesla have not fallen as precipitously due to the COVID-19 pandemic. In fact, expectations for 2020 EPS currently sit at $437 a share. Meanwhile, expectations for 2021 are nearly 3 times as high at $12.9 per share. If Tesla fails to meet or beat these soaring expectations, shares could fall significantly to a more rational level, with the current stock valuation implying a greater market share than Tesla or even its analysts predict. It is only a matter of time before analysts and investors will have to reconcile their unrealistic hopes with reality. Number 9. Executive compensation adds additional risk. Tesla made headlines in early 2018 with a new compensation plan for Elon Musk that the New York Times described as the boldest pay plan in corporate history. Bold is one way to describe the plan, which provides for 12 escalating tranches of stock option grants based on hitting market cap, revenue, and adjusted EBITDA levels. We would call it foolhardy. In many ways, Musk's compensation plan reminds the misaligned incentives that led to the blowup of Valiant. Like Valiant's plan, Tesla's compensation plan uses adjusted non-GAAP measures and outrageous valuation targets that incentivize excessive risk-taking with no accountabilities to the true fundamentals of the business. Tesla's compensation plan could encourage value-destroying acquisitions, shareholder dilution, earnings management, and a focus on keeping the stock price higher rather than building a long-term profitable business. Without significant changes to its executive compensation, Elon Musk is incentivized to boost top-line growth numbers with no attention to prudent capital stewardship. Tesla should have to pay tithe to improve ROIC, which is directly correlated with creating shareholder value. Number 10. Growth may also be constrained by product portfolio expansion, refresh, or lack. Tesla may also face changes in further growing volumes with a narrow product portfolio with no real model refreshes. Specifically, Model S X appears to have experienced a traditional spike and burnout pattern after or during the launch ramp, while Model 3 continues to grow with some fluctuations, although demand may be cannibalized to some degree by Model Y as it is introduced. All these fluctuations are hitting down the Tesla stock. So these were our top 10 dangers for Tesla stocks. Make sure to leave a like and subscribe so you can join the Tech Factuala squad and be a part of our channel. Thanks for watching.